Welcome to Edison TV. I am delighted to be joined by Kirsty Gibson. Kirsty, for those less familiar with the trust, perhaps provide a brief introduction to the trust and yourself.
Yeah, so we are looking to invest in the most exciting growth businesses in America, whether they are publicly or privately traded. And we're looking to invest in those companies driving structural change, those which we can invest our clients' capital into for 5+ years, those that we believe have the potential to deliver disproportionate outcomes over time. And the trust is managed by Gary Robinson and myself. And, we know from academic research and from our own internal work that it's a small number of companies that drive all the return over longer periods of time. So therefore, it's not about how often you're right, it's about how much you can make for clients when you are. We also recognize that the path to success will not always be smooth. Driving change takes time. There are paradigm shift, changes in the environment. But we do believe that the trust companies share some common characteristics. They are addressing large and often expanding market opportunities. They have strong competitive positions or the opportunity to build one, and they have distinctive cultures. And in short, those are the features of the exceptional growth businesses that we spend all of our time trying to find.
Yeah, and reading about the approach, the strategy really talks about finding outliers. Perhaps just inform us a little bit more in terms of what you mean by outliers, and then also explain the opportunity map. Are you finding plenty of opportunities at undemanding valuations?
I think outliers by definition rarely look cheap on conventional multiples or metrics, especially when they're early in their growth journey or they're reinvesting really heavily. So ultimately, we're not screening for low valuations per se, but for those situations where we feel the market is underestimating the range or potentially the scale of future outcomes. This is particularly powerful in periods of paradigm shift, when something genuinely changes, whether that's a new technology, a step change in productivity, or a different way of delivering outcomes, the past becomes a less reliable guide. And I think one thing is that markets are very good at pattern matching backwards, but they're much less comfortable imagining structurally different futures. That's often when traditional valuation anchors can obscure opportunity rather than actually reveal it. And I think AI is a really good example here. Many businesses exposed to AI are still being valued through a lens shaped by pre-AI economics. We're looking at historic margins, historic cost structures, historic growth ceilings. But if AI meaningfully changes how work is done, how software scales, or how decisions are made, for example, then the long-term profit pools and the competitive dynamics could look quite different from the past. And in that context, in some cases, near-term uncertainty can dominate, even as that long-term optionality increases. So while we're not finding undemanding valuations in the classic sense, we are finding situations where expectations are low relative to the sort of scale of the change that's underway. And that's where upside asymmetry ultimately comes from, and that's what we're trying to focus on. It's not from extrapolating the past, but it's from recognizing when the future is likely to be structurally different and backing the company's best position to benefit from that shift.
Okay. And last year you introduced, I think, the concept of enhancements and guide rails in terms of managing the trust. What led to the introduction? What were the specific measures, how they've implemented? And have you started to see this approach actually show up in the trust performance?
So I think the enhancements and guide rails that we've spoken about, they came from a period of reflection that we were very keen to ensure wasn't done in a moment of crisis. We've been through a period of volatile performance, and we wanted to be more explicit about where conviction should be highest, where uncertainty is completely acceptable, and where we should be potentially more cautious. And the guide rails are really about discipline in portfolio construction more than anything else. So, for example, they're ensuring we are thinking about the breadth of potential outlier businesses available to us. So recognizing that exceptional growth businesses come in a lot of different forms and ensuring we don't become too narrow in our focus. They're also about helping us think about the ability of the trust holding to survive the long term and survive the short term and navigate the long term. How much of the portfolio is in profitable or cash generating businesses, for example. It's about that resilience and that adaptability. It's also recognizing the underlying correlations in demand drivers that we have within the portfolio and how much exposure we're comfortable with to a specific demand driver, such as, the battle for attention. We're spending more and more time potentially doing things online. And how many of those sorts of companies do we feel comfortable owning? And then I think the final thing is, ensuring that we're stress testing our own narratives as well. Ultimately, these guide rails don't change the philosophy. And I think it really is too early to draw firm conclusions on the performance impact. But I'd say that one of the biggest benefits so far has been clarity, both internally and for our shareholders, about how we balance ambition and risk. The performance of the trust will be volatile. We are investing in growth businesses driving structural change, but we also recognize that volatility needs to be within reasonable bounds.
Okay. And the trust invest in both public and private market securities. What's been your historical range in terms of private company exposures? I know you got a maximum of 50%, but I'd be interested to know how close you get to that. And is the level of private exposure a source of pushback from potential investors? Is this something that they are concerned about?
So the private exposure has varied meaningfully. And I think that reflects opportunity rather than a target. Gary and I don't manage this portfolio to have 50% in private. It allows us the flexibility to own exceptional growth businesses, whether they are public or private. It's often been well below the 50% limit. It was closer to 20% when the IPO market was highly active in 2020 and 2021. It currently sits at about 35. And periods of higher exposure have been driven by exceptional private companies staying private for longer, alongside public market valuation declines. So obviously, when public market valuations have declined, that's pushed the percentage of private investments up if their valuations haven't reacted in the same way. In terms of pushback, I think it highly depends on the investor. Some might want it to be higher. Some actually want it to be lower. I think a long run average with a healthy IPO market. So I would say the IPO market during 2020 and 2021 was probably more enthusiastic than it's been historically. And I'd say that the past few years have been, we've been in a period of almost closure. So I think, but a long run average is probably in the 25 to 30% range. Why? Because we're not looking to invest in early stage businesses. We are investing in later stage. And while we don't push companies for an exit, many have an IPO on their medium-term agenda. So we would expect that, several of these companies are going to IPO on an annual basis. I think, secondly, a more healthy IPO market would see both ends of the funnel flowing. So companies becoming public and new companies entering the funnel as interesting potential investments for the trust. I think what's really key to mention, though, is the reason we launched the trust was to provide investors with access to some of the most exceptional private companies in the US alongside those in public markets, and harnessing the reputation of Baillie Gifford as a long-term supportive shareholder to provide trust shareholders with access to the most exciting private businesses in the US. And I do believe that we have done this well. Anthropic, SpaceX, Stripe, Zipline, Rippling are holdings in the trust, and they are evidence of this.
Yeah, fantastic names and household names as well. We've talked quite a lot about sort of investment philosophy, approach, a little bit about sort of risk management and sort of guardrails. I feel like it always brings it to life when you start talking about actual transactions and things that you've got involved in. So perhaps give us a couple of examples and rationale for recent portfolio transactions, either things you bought or sold, and the reasons why.
Absolutely. So I mentioned one of the private companies, and obviously it's a name that is certainly on people's agendas at the moment. That would be Anthropic. So Anthropic is a private AI company building large language models, specifically focusing on the enterprise. What sharpened our conviction over time here is seeing the company move from being research-led to having increasingly clear commercial relevance, particularly in enterprise use cases like coding. Tools such as Claude Code are starting to embed in real decision-making processes, and it's not just an experiment anymore. And ultimately, there is a possibility that Anthropic becomes a foundational layer in how intelligence is deployed across organizations. And I think that's important because if they succeed, they don't just grow, they become infrastructure within the economy. Another one, a relatively new buy in the public space, is an IPO that we participated in of a company called Circle. So Circle is a financial technology company that operates USDC, which is a stable coin to move digital dollars quickly and cheaply across the internet. So with Circle, we're investing in the plumbing of digital finance. Stable coins are not about speculation. They're about settlement. They're about liquidity management. They're about cross-border payments. As more commerce becomes digital and global, the ability to move value instantly and reliable becomes much more important, not less important. And so Circle sits at a really interesting intersection of technology, regulation, trust, and its role in USDC, its engagement with regulators, and its focus on compliance all matter because money is a system where credibility compounds. So if stablecoins continue to be adopted as rails for payments and financial infrastructure, we believe that Circle has the potential to sit at a really interesting control point within that mechanism. Completely different type of business. We bought a holding in a company called Knife River, which is a US-based producer of aggregates and construction materials used in roads, infrastructure. Knife River illustrates that long-term compounding doesn't always come from flashy technology. Infrastructure demand is persistent, it's local and long-lived, and aggregates are heavy and expensive to transport and hard to substitute. And that creates a lot of natural barriers to entry, and it rewards scale, reliability, and the ownership of the actual assets. So we believe that its local advantages will allow it to compound steadily with the opportunity for significant margin expansion.
Okay, that's really good, and I think gives you both a sort of how you look at the world, but also the breadth that you're looking at. I can't let you go without. I mean, I think I'd like to stitch together a couple of points you made. So, and the outliers, you sort of hinted at what the world might look like if AI was deployed, and also you've touched on Anthropic and it becoming sort of the infrastructure, an opportunity to bring that together. So, just express why you're so upbeat about your AI exposed holdings, and then perhaps highlight a couple of other areas in the portfolio where you think the prospects are equally bright.
Sure. I think I'm upbeat on our AI exposed holdings, not because AI is a fashionable theme, but because of where those companies sit in the system and how AI potentially interacts with their existing advantages. So in some cases, AI is reinforcing businesses that were already structurally very well positioned. NVIDIA is the clearest example here. It sits at a foundational layer of the ecosystem, supplying the compute to almost every serious AI workload that depends on it. And as AI adoption broadens, that position doesn't necessarily get eroded. In fact, it probably becomes more central. And the same is probably true of a company like Meta. Meta already has global distribution. It has very deep data. It has highly efficient monetization engines. And AI allows them to improve relevance, efficiency, creative output across the system, and crucially to deploy those improvements at scale almost immediately. And so what gives us confidence in that is, in these cases, is that AI acts as an accelerant rather than a disruptor. It magnifies the advantages that were already there in terms of distribution, data, workflow. And that ultimately tends to widen the gap between leaders and everybody else. At the same time, we are also really excited about the areas where AI has the potential to reshape an industry structure rather than just enhance it. So businesses like Anthropic that I mentioned earlier or Runway AI sit at emerging control points in the stack where small changes in capability or adoption can have really large downstream effects. Now, these are earlier stage, but they offer a very different return shape. where one where the upside feels genuinely unbounded if they become foundational to how intelligence or creative work is deployed, for example. Now, beyond AI, there are other parts of the portfolio we think the long-term prospects are really quite bright as well, even though they don't always grab the same number of headlines. One is digital infrastructure more broadly, the plumbing that supports how data, commerce, and communication actually happen. And then I guess healthcare would be another area that I would flag as well, because while progress can be uneven and the underlying engine of innovation of AI potentially enables better science, it enables better tools, it enables better data, that's going to continue to help expand that opportunity set as well. So I think what links all of this is less about predicting which trend will be strongest next year and more about owning businesses that we believe can convert any type of change into their advantage.
That's great. I think we've had a pretty broad sort of coverage of, the trust. Are there any elements of the story that you'd like to emphasize before we wrap up?
I think I maybe just say that the Baillie Gifford US Growth Trust is designed for a very particular kind of journey. Returns are unlikely to be smooth, narratives will change, and patience is essential. But we believe that by staying focused on a small number of exceptional businesses and holding through periods of discomfort, we ultimately maximize the chance of capturing the kinds of outcomes that really matter over the long run. It's not about being right every year. It's about being right on those few things that really, really matter.
I love the approach. I love the clarity. I found it for someone who's been looking at markets, it's been a pleasure to hear about particularly some of these sort of really interesting companies like Anthropic and your views on AI. Thank you very much for coming on Edison TV, and I hope we can reconnect with you in a few months' time to see how much progress you've made.
Great. Well, thank you very much for having me.